Hey everyone, have you ever wanted to transfer money to your kids or real estate, but you wanted to do it in the most tax efficient manner and of course, help them also learn to save and invest? Well, then you definitely want to check out today's video because I'm going to talk about tax tips for transferring money, real estate, wealth to your kids. I want to say one thing. I can't stress this enough. Make sure that you're in a good financial position. Don't ever put yourself in a position where you can't even retire or live comfortably, because you got to take care of yourself before you can take care of your kids. So make sure you're in a very, very sound financial situation before you look to displace or transfer money to your kids as a gift. And also, goes without saying, I am not an accountant, so all this is for entertainment purposes only. So if you plan to do some tax planning or transferring your wealth and assets, be sure to talk to a certified legal advisor. Get good tax advice because it's well worth it. Now, the first strategy, which is I think is so cool, is that you can help them set up a TFSA once they turn 18 and max out their contribution. So every year, say it was this year, you can contribute up to $6,000 tax-free into their tax-free savings account and then have them invest into assets so that they could grow their wealth and compound it. And man, I wish I would have done that when I was 18, but when I was 18, tax-free savings account didn't even exist. Now, maybe you don't want to just give them handouts, like just give them the full $6,000 and then they might just take it out and spend it on like dumb stuff. What you could do is get them into a great savings habit. So for example, you could contribute a certain amount if they match it. So if they happen to work at a part-time job and they have some savings and they contribute, say, $300 in their tax-free savings account, what you could do is match it up so it becomes a game, and you can game it up so that your kids are actually incentivized, I can't say that word, want to actually match the contributions into the TFSA because they get free money from their parents. And most importantly, by doing that, you could help them learn how to invest, learn about taxes at such a young age. Another way you could do it is maybe you have some really awesome stocks that you want to transfer over to your kids. Well, one thing you could do is you could sell them and then transfer it to your kids. Now, of course, you pay capital gains, of course. You get taxed at 50% capital gains. But if you transfer some assets to your kids' TFSA, well, it can grow tax-free and they have a lot more years and a lot more growth. Even if it's like as little as $6,000, that's like with compounded effect over the years, over a 20, 30-year period, well, it's ginormous. So it may be worth it to pay a little bit taxes up front so you could transfer some of your assets to your kids' TFSA. Now, the next strategy is if you've always wanted to transfer an asset, like a rental property or some type of capital property like a house or a condo to your kids, but you want to do it in the most tax efficient manner, well, you can do it. You just need to spread over a 5-year period. And this is how it works. Say you sold an investment condo and you had a capital gains of $250,000. Your marginal tax rate would be around 43%, according to this income tax calculator, which I've linked below. But if you manage to spread that capital gains over a 5-year period, meaning you sold that property in increments over a 5-year period to your kids, your $250K would be spread over 5 years, increments of $50,000 every single year. So this would drop your income tax rate. Your marginal tax rate would top at around 20%, which is leaving a lot of money back in your wallet. But this means, of course, your kids have to spread out the payments over a 5-year period to buy back your investment property, because you can't transfer an investment property like a rental property without paying any capital gains, even if it's to your kids, unless it's your principal place of residence. But if it's rental property, you do have to pay capital gains, and this is a great way to reduce your capital gains. And of course, transfer more money and assets to your kids. Now, the next strategy is an informal trust. Now, I've been spending a lot of time thinking about this one because this is something I actually want to open up. I haven't yet, but I'm almost there because I'm like at a point where a lot of my assets are going to be transferred over to my kids. My kids are so lucky. Now, of course, they're spoiled brats, then of course I'm not going to transfer it to them. But I was thinking this informal trust could be built not just for my kids, it'd be for my nieces and nephews, for future generations. It's like my way of leaving a legacy for future generations to cover like education costs in the future, because you know, education costs, tuition fees are like skyrocketing. So the way to do this is you could go open up an informal trust with a brokerage account like Interactive Brokers, and then you transfer money in it and you start investing in that account. Now, if you start collecting dividends or interest income, it gets taxed at your income tax rate. But if you have growth in that account, well, it gets taxed at your kids' rate. So they might not have a lot of money in the future, especially if they're turned 18, be going to school. This is a great way to withdraw some money and they get taxed at their rate, which is essentially almost zero. So this is an awesome strategy to start growing some money that you have for your kid and have it grow compound over the years, and then it gets taxed at their income tax rate rather than your own. Now, the next strategy is maxing out your registered education savings plan. I know how it feels. As a busy mom, way back in the day when I was carrying twins, I was like, I didn't have any time. Focus too much on just trying to feed my kids and have them survive when they're newborns. But did you know you have 31 years, up to 31 years to contribute to your RESPs, and you have a contribution limit of maximum $50,000. Just be careful if you over-contribute. There's just a smidgen you can over-contribute, but if you do happen to over-contribute over what they even allow, you get taxed at 1% per month as a penalty, okay? Now, why I'm saying please try to max out your RESPs? Well, because the government gives you free moolah, and who doesn't like free moolah? The government will contribute about 20% every single year to a maximum of $500. And remember, you can contribute up to 31 years. Why I love the RESPs is because you can grow the investments in the RESP tax-free, and then when your kid is ready to go to university or college or trade school, they can withdraw those funds and it gets taxed at their rate, which hopefully is essentially zero, okay, because they're going to be poor. And there's a huge compounded effect. I mean, even if your child decides to go to school like when they're 28, 29, it's still okay because you have up to 31 years before you withdraw your RESPs. Now, the next strategy is much, much long-term, but hey, this is all about transferring your wealth in the most tax-efficient manner. So even if it's super long-term, when it comes to your RSPs and you're at a point where you're going to retire, you need to convert it to an income fund, which is a RRIF. Well, please name your beneficiary. You can name your child as a beneficiary, and that way it avoids probate fees. Of course, this is in the event that you still have funds in it. So that's how you avoid probate fees, which are super high in Canada, especially Ontario. So please name your beneficiary to your kid, or of course you can name it to your spouse, but you can also name your child. And that's a way to transfer wealth to your child much more tax efficiently. Now, be careful. If you name anyone else other than a qualified beneficiary, like your kid or your spouse, well, that person is going to get taxed heavily with your RRIF. Now, but if you name it to your kid, well, it gets transferred tax-free and you avoid probate fees. Now, the next strategy is sign up for life insurance if needed. I suspect if you're transferring wealth to your kids, you're probably leaving them a nice, decent inheritance, and you're probably going to think about taxes because there are certain things that are guaranteed in life, and that's death and taxes. So by having a life insurance plan, it could just give you a bit of protection, of course, while you're alive, but also as a way to reduce your capital gains because taxes are guaranteed when we all die. So if you want to reduce the tax burden of future generations, well, the payouts from the insurance plan is tax-free. Now, this is especially important if you want to reduce the taxes for future generations because the payout from the insurance plan is tax-free and it can help you pay off debt, a little bit of mortgage that's left on the rental property, capital gains. Now, before you sign up this type of insurance and this protection for your family, please think of your goals and what's your end game and determine how much money you think you need to reach your goals and your end game. And that way, an advisor can help you develop the best insurance policy for you. Hey everyone, if you want to know more about the Registered Education Savings Plan, the RESP, the pros and cons, what to do if your kid decides not to go to school, you might want to check out this video out here. I do a deep dive on the RESPs. Anyways, I hope you found this video super helpful. If so, all I ask of you, give me a thumbs up and of course subscribe and hit that bell notification button. Hit it.